From the current FDIC chair, Yelena McWilliams, to the former FDIC chair, Sheila Bair, who's widely credited with preventing a run on the banks during the 2008 financial crisis. She's just been named the head of the government-sponsored enterprise Fannie Mae, the leading source of financing for mortgage lenders in the U.S. Great to have you, Sheila. Let me first get right now to what is happening in the Senate at the moment. They're working to make sure that the soundness and the safety of the financial system, and most importantly, deposits of everybody watching right now, remain safe. Can you assess, knowing what you know and your experienced eye, how the health of the financial system in the U.S. Looks right now and where you see potential stresses?
Right. So I think at least the regulated sector, the regulated banks, the FDIC insured banks where households have their deposits, I think that's still relatively stable. A lot of unknowns. And of course, as the former FDIC chair, I have to say, if you have your money in an insured bank account, make sure you're below the insured deposit limits. But if you do, you really don't need to worry about whether your bank is going to be healthy or not. But overall, I think most banks are still stable. A lot of unknowns, though. We don't know how bad the economic consequences of this pandemic could be. There's some positive signs now, but it takes a long time for losses on loans and other credit to flow through to the banking system. So it's really an unknown at this point.
Well, yeah, that's the thing. Sometimes, a shipwreck goes down and you don't see it until portions of it start floating up much later. So to that point, it's a lovely analogy. At least I didn't say bodies. Tell me what you anticipate. I mean, what are the worst case scenarios so that we are prepared?
Right. So the worst case scenario is we do not have a vaccine. The pandemic continues to worsen. We have business closures again. Distressed sectors, travel, hospitality, energy, retail are going to become even more distressed. We don't get fiscal support, which we need, frankly. I think we're kind of spent on monetary policy as a tool. Congress needs to step up with support to households. But if none of those things happen, we could be in a very bad situation, because as households become more distressed, businesses, small businesses in particular, become more distressed. They start defaulting on their loans. Those losses flow through the banking system. The banking system becomes distressed, and then you have a financial crisis in addition to a health crisis. So that's the worst case scenario, one I don't think is going to happen. But nonetheless, I think it does argue for bank regulators and bank leadership to be highly cautious and prudent right now. Retain your capital, keep a strong balance sheet, because we just don't know what's going to happen.
And what do you make of what happened in sort of that first quarterly earnings report for the big financials right at the height of the pandemic, where the first thing that got a lot of attention were the cash piles that they had set aside, the dry powder for potential, foreclosures and debts that went wrong way. You had a lot of defaults that could have happened, mass loan defaults, which haven't yet come to pass. You had $34 billion, JP Morgan Chase put aside, Goldman Sachs, $4 billion, Wells Fargo, $20 billion. But have they overcorrected and become too tight-fisted? It's very hard for a pizza parlor or a manicure salon or a first-time home buyer to get a loan right now from those guys.
Well, they should be lending to those guys. They absolutely should be lending to those guys. If there's, if you have a business that's still functioning, still bringing in revenues, still managing, you should be lending to them. And a lot of those substantial loan loss reserves were a function of a new accounting standard that coincidentally went into effect at the same time this thing was hitting. But that's good that they build up that loss absorbing capacity so they can continue to lend. That's the whole idea. And one of the reasons why I've argued that they really shouldn't be paying dividends and certainly not buybacks right now, and they have suspended those, because they need to retain capital to maintain ample balance sheet capacity to lend. That's exactly what they should be doing.
We just had President-elect Joe Biden speaking, and we wonder what kind of regulatory actions we might see under a Biden-Harris administration. When he was elected, President Trump and his administration made it very clear that their mandate was to deregulate, and particularly with Dodd-Frank, the 2008 financial era crisis management law. They did, President Trump, and it was a welcome move for a lot of regional and community banks. He was able to eliminate the onerous regulations that painted them with the same brush that the big financial institutions who really got us into trouble were painted with. So, what do you expect under Biden-Harris, and what do you hope remains from what President Trump did?
Right. Well, I'm sympathetic to some of the loosening that was done for the regional banks and certainly the community banks. There was too much of a one-size-fits-all, though the Trump regulators have provided a lot of relief to the very largest guys as well, and that is troubling. I don't know. I think Mr. Biden's got a lot of smart people advising him on financial matters. My guess is that they will no longer be so industry friendly. That if anything, they may be tightening regulation a bit, at least for this large systemic institution. I think and hope they will also be focusing on the non-bank sector. That really that's been a source of stress through this pandemic. Money market funds blowing up again. Leverage building up with life insurers. Hedge funds, highly leveraged. A lot of the credit intermediation moved to the non-bank sector as we tighten regulations on banks, and that is becoming a source of systemic risk as well. So my guess is that the non-bank sector is going to be an area of focus for the Biden administration and Biden-appointed regulators. I think climate change as well is going to be a big area of focus. This is increasingly becoming an issue for financial regulators. Climate change is creating new risks and uncertainties, unsustainable businesses, exposed businesses that banks really need to start taking into account as they manage their own risk in terms of their lender relationships. So my guess is that the Biden folks will focus on that as well. Nice seeing you, Liz. Thanks for having me.
Sheila, I'd love to see you in the administration, whatever may happen here. It'll be great to see.
Well,
no go on Treasury. You're not interested. All right. Thank you.
Okay. Thanks, Liz.